Welcome to the Deep Dive. We cut through the noise to deliver the insights you really need. Today, we're tackling a pretty big question. How does a major financial player like ICICI Securities actually navigate these dynamic markets? And maybe more importantly, what strategic moves are underpinning their performance when you see profits, well, practically doubling? What's that signal for the broader Indian financial landscape? We're doing a deep dive into the Q1 FY2025 financial results of ICICI Securities Ltd. Our mission here is to go way beyond just the headline numbers. We want to uncover the significant insights, the emerging trends, and the crucial business updates from their performance. This is for the April to June 2024 quarter. Now, our sources for this are their official investor presentation and the detailed performance note for Q1 FY 2025. These give us a really thorough breakdown: revenue, profit, segment performance, key financial ratios, the works. Okay, let's unpack this and really see what stands out in ICICI Securities' latest numbers. So let's kick things off with the big picture, the Q1 FY 2025 performance snapshot compared to the same quarter last year. Revenue first.
It hit an impressive 16.44 billion. That's soaring up 76% year on year. And interestingly, it's even up a solid 6% quarter on quarter. Now, the report says this growth was largely spearheaded by increases in broking income and investment banking. Then there's profit after tax, or PAT, which for you listening is basically the company's net profit after all the expenses and taxes are paid. That came in at 5.27 billion, an astounding 94% jump year on year, although it did see a slight 2% dip compared to the previous quarter. But here's a figure that really jumps out. Their return on equity, ROE, for Q1 FY 2025, it's skyrocketed to 53.7%. That's a massive leap from 36.3% back in Q1 FY 2024. Total assets also saw significant growth. They're standing at 7.4 trillion, up 20% year on year. And within that, wealth assets grew to 4.5 trillion. That marks a substantial 31% jump year on year.
That is an incredible leap in those top line numbers. I mean, looking at profit nearly doubling. And that ROE jumping over 50%. It's not just growth, it's, well, hyper-efficient growth, isn't it? For investors and really anyone looking at financial health, this just screams effective capital management. But it also prompts us to ask, right? Is this level of growth actually sustainable? And what underlying factors are driving such a rapid expansion, especially given the market dynamics in India right now?
That's a crucial point. And to really understand the engine behind this performance, we need to sort of peel back the layers. We need to see which specific business segments are really firing on all cylinders. Okay, so retail broking and allied revenue, it stood at 9.91 billion, up a massive 92% year on year. Now, the company explains the surge was largely due to an increase in cash volumes and also growth in their equity allied business. A key driver here seems to be their average margin trading facility book, the MTF book. It grew by an incredible 131% year on year. Now, for you, the listener, MTF is what allows clients to trade with borrowed funds. It amplifies their buying power. So this massive growth, it signals a very active, perhaps even bullish, retail investor base leveraging their positions through ICICI Securities. In fact, they're noted as a leader in this MTF market. They hold approximately 20% market share based on the exit MTF book. Okay, moving on. Distribution revenue was 1.76 billion. That's up 11% year on year, though it did see a slight dip quarter on quarter. Then there's institutional broking and allied revenue. This one really shone. Came in at 1.27 billion, jumping 111% year on year. This growth, they explain, is largely attributable to momentum gain in cash average daily turnovers, or ADTOs, and also significant block deals. It seems the franchise has also consolidated its position among the top domestic institutions, and they're actively strengthening their FII, that's foreign institutional investor franchise, by entering into new partnerships. And for a truly dramatic surge, look at issuer services and advisory revenue, hit 1.16 billion, skyrocketing 251% year on year. This explosive growth is apparently a direct result of increasing deal flow and a continued focus on building non-IPO revenue streams. Finally, other revenue came in at 2.35 billion, up 38% year on year.
Yeah, and if we connect this back to the bigger picture you started with, the explosive growth in retail broking and issuer services really tells a compelling story. It speaks volumes about broader market activity in India, but also about ICICI Securities' strategic positioning within it. It's not just about the overall market lifting all boats, right? It's about how effectively they seem to be capturing that momentum, expanding their client base, capitalizing on market demand. It also highlights, I think, a strategic diversification of their revenue streams within broking and advisory. That makes their overall growth potentially more resilient. But that reliance on MTF, as you pointed out, also raises interesting questions about market risk exposure, something to keep an eye on.
That's a fascinating point. Okay, so we've seen massive revenue growth. But the real test often lies in the profit and loss statement, doesn't it? This is where we can really dissect how those booming business volumes translate into expenses and ultimately into profit. So, what were the most significant shifts you noticed on the income and expense side when you look through the P&L?
Absolutely. It's crucial to see both sides. On the income side, interest income for Q1 FY 2025 surged by nearly 90%. That's up to about 5.83 billion. Now, this was largely due, as you'd expect, to the increase in average MTF funding and also the fixed deposit book. Brokerage income also soared. Over 81% growth to roughly 6.22 billion. That reflects a significant increase in equity and derivative volumes, busy markets. And income from services grew over 64% to about 4.15 billion. That's thanks to increased issuer services, advisory fees, and mutual fund income. One area that did see a decrease, interestingly, was net gain on fair value changes. That was down by about a third to 207.8 million, mainly due to movements in their treasury segment, apparently. Okay, now flipping to the expense side. The increases here are equally informative. They really reflect the cost of this rapid expansion. Finance costs jumped over 113%. That's nearly 3.94 billion. This surge was largely a result of increased borrowing, which was needed to fund that rapidly expanding MTF book we keep talking about. And alongside that, higher borrowing costs linked to, well, rising interest rates in the broader economy.
Fees and commission expense rose 92% to 742.1 million. The notes say this is largely attributable to increased revenue-linked payouts to their partners. Makes sense. Operating expenses were up 58% to 529.2 million, mainly due to higher operating costs directly tied to that increase in volumes. More business, more costs. Employee benefits expenses increased 31.7% to 2.65 billion, primarily due to annual salary increments and an increase in headcount, again logical with business expansion. And depreciation, amortization, and impairment expenses saw a 64% increase to 366.1 million, largely on account of depreciation and amortization of technology-related assets, investing in tech. Finally, other expenses were up 22.5% to just over 1 billion, primarily, they say, due to an increase in technology expenses again.
Right, so we've seen how that robust revenue growth and the increased MTF activity translate pretty directly into higher finance costs and operational costs. It's the cost of doing more business. Okay, looking now at the balance sheet. Comparing June 30, 2024 to March 31, 2024, we see some clear trends. Total assets increased significantly, grew by over 8% from roughly 256 billion rupees to nearly 278 billion rupees. And the company explains this was largely driven by that significant expansion of their MTF book, which grew from roughly 116 billion rupees to over 146 billion rupees just in that quarter. Wow. Correspondingly, total liabilities also increased by over 8% from roughly 256 billion to nearly 178 billion. This increase primarily driven by a rise in debt securities, so borrowing more. Interestingly, equity saw a slight decrease, down 0.3%, very small change there.
This definitely raises an important question, doesn't it? The growth in assets, particularly that huge jump in the MTF book. It's very clearly being funded by increased liabilities, primarily those debt securities. So what does this tell us about the company's growth strategy and its financial leverage?
Well, it suggests a pretty aggressive, yet you'd hope managed, approach to leveraging capital. Using debt to fuel expansion in these high-growth areas like MTF, it's a strategy that can really amplify returns in good times, like we're seeing now. But it also warrants attention, definitely, in terms of risk exposure if market conditions were to change.
Good point. And beyond just the quarterly numbers, it's worth appreciating the impressive scale of the ICICI franchise over the longer term. Looking at their compound annual growth rates, their TIGRs from fiscal year 2019 to 2024, the numbers are really quite impressive. Profit after tax grew at a 28% TGR over those 5 years. Revenue expanded at a 24% CGR. Total client assets climbed at a 24% CGR, and wealth client assets saw even stronger growth at a 33% CAGR. Their return on equity was a strong 50% for FY 2024, and they've maintained a consistent dividend payout policy over 50% payout. So these impressive TGRs, they clearly show ICICI Securities isn't just having a good quarter, it's consistently scaling over time. But growth isn't just about the top line or the balance sheet anymore, is it? How does their stated commitment to a purposeful ESG agenda, environmental, social, and governance, which we see laid out here, actually tie into and maybe even bolster this long-term financial performance? Are there tangible benefits beyond just, reputation?
Absolutely. That's a critical question today. ESG isn't just a nice-to-have or a tick-box exercise for a company of this scale anymore. Increasingly, it's seen as integral to long-term value creation and risk management. For instance, look at their focus on robust data protection and cybersecurity. That isn't just good governance. For a financial firm, it directly mitigates potentially huge operational and reputational risks. It secures client trust and helps prevent those multi-million-dollar breaches we sometimes hear about. That's tangible value. Similarly, reducing their environmental footprint through targets for energy, paper, travel reduction It reflects a management perhaps looking ahead. They're keen on future-proofing operations against rising energy costs, potential regulatory pressures, things like that. On the governance side, having an independent board, clear ethical policies, they mention code of conduct, anti-money laundering, POSH, and segregated management structures. All of that strengthens investor confidence. It reduces the likelihood of financial irregularities or scandals down the road. And their investment in human capital. You see it in the employee training hours, the focus on new hires that translates directly into a more skilled, more motivated team, which ultimately impacts client service, innovation, and retention. Even their CSR initiatives, impacting over 100,000 lives, supporting startups, that builds community goodwill and a strong brand perception, which, maybe indirectly, supports business growth and helps attract talent in the long run. So yeah, it's becoming a much more holistic approach. It can lead to more resilient and, importantly, sustainable financial performance over the long term.
Right. So what does this all mean for you, the listener? It's not just about the numbers, though they are impressive. It's also about understanding the underlying philosophy and the strategic direction of the company, especially when it comes to things like sustainability and robust governance. It shows a holistic approach to growth that goes beyond just the balance sheet figures. Okay, so to quickly recap, ICICI Securities delivered a really impressive Q1 FY 2025, substantial year-on-year growth driven largely by their retail broking and investment banking segments, and significantly boosted by that margin trading facility funding. This growth seems supported by a robust and diversified business model. And importantly, there's a clear commitment noted towards their long-term franchise development and a pretty comprehensive ESG agenda that appears, at least on paper, to be integrated into their operational strategy.
Yeah, exactly. This deep dive into ICICI Securities Q1 results really highlights how financial performance is influenced by, several factors working together. Not just booming market dynamics, not just strategic business decisions like focusing on MTF or advisory, but increasingly by a stated commitment to responsible and sustainable practices. It really encourages you, the listener, to look beyond just the top-line numbers when you're assessing a company's health, and also its potential for future growth, and maybe its resilience when faced with market shifts or changing stakeholder expectations.
So here's a final thought to leave you with. Given the robust growth we've seen in their broking and advisory segments, and their clear focus on technology and human capital alongside this ESG commitment, how might a company like ICICI Securities continue to shape the financial landscape, particularly in a rapidly evolving market like India? And maybe more personally, what does that mean for how you approach understanding the broader economy? Especially when you consider this interplay between rapid financial growth on one hand and strategic long-term investments in areas like ESG on the other, definitely keep exploring financial reports and company presentations to gain those deeper insights.